Today I want to talk to you about one of the most important aspects of real estate investing. A lot of people don't think about this. They understand they want to get into real estate. They understand they want to make some cash flow. They understand they want to do some flips, whatever the case is. But they don't understand this vital principle. And this principle is called leverage. This is back to the old Archimedes quote saying, give me a lever long enough and I can lift the world. And that is a principle that real estate investors that are really good understand. Because real estate investors understand that over time, a couple of things happen. What real estate investors know is that over the long term, rents go up. Period. They know rents go up. Look at 1940 to 2021, median rents have gone up drastically. As a matter of fact, they really haven't ever gone down. I mean, they might have kind of slowed down, but if you look at this, they really have not gone down. Okay, so that's the first thing real estate investors know. So they know if I can tie up a property now and over time rents are going to go up, over time, I'm going to make a lot more money and a lot more cash flow. Okay, so that's the thing. And as a matter of fact, even if you look at the worst financial crisis of all time when it came to real estate, you know, that 2007, 2008, you can see the median house price went from 242 down to 208. It was like a 15% decline. And then it came back up, it came down just a little, and then it's been on a steady stream. You'll see there's these little ups and downs, but if you look at what's happened since the bottom of 2009 at 208 till, I don't know where we're at now, 420, it's almost doubled since 2008 to 2024. Over that 16-year period, real estate has almost doubled. Okay, so the idea is this is a land grab. This is like homesteading in the wild, wild west. Let's grab as much as we can and hang on to it because it's all about staying power, okay? So what limits most people to do that is capital. So what I like to say is uneducated investors ask, how much does it cost? Educated investors ask, how much money do I need to put down? Because real estate investors are more worried about the leverage than they are about the cost. As long as they can make money and they're tying something up over the long term and they know rents are going to go up and they know values are going to go up. And there's two more things we actually didn't talk about, which is the tax benefits. They know that they're going to have tax write-offs both from the business side and from the property side, from interest to accelerated depreciation or just standard depreciation. They're going to be able to write things off, which will offset their personal income tax tremendously. And I know that my tenant is going to be paying down my mortgage each month. I get all of those benefits even if I'm not making cash flow. So what I'm looking to say is, how many of those properties can I get? Because the more properties that I can get, the sooner I can get them, and then I let time do its work. That's how I increase cash flow and wealth tremendously, is tying up as many as I can. So I believe the single family houses are the most undervalued investment strategy that there is. The nice thing about houses is it's a tangible asset. It's a basic necessity, food, shelter, and clothing, and everybody's going to need it. And as we've seen, rents go up, property values go up, appreciation happens. Those are the things that we're looking for that are happening. So the first thing that I want to talk about is DSCR. This stands for Debt Service Coverage Ratio. And basically what this means is that you don't have to worry about income qualifications. You don't have to worry about your debt to income ratio. It used to be you had to have enough income to cover the debt. What the DSCR loan looks at is it says, hey, we want to make sure that you've got like 1.1 or 1.2 times the rent to the payment. What that means is if your all-in payment with taxes, insurance, and everything else is $1,000, then rents need to be $1,200. And if you have that, they don't care about the debt to income. They don't care about your income, tax returns, or any of that type of stuff. They just want to make sure that you're not in a bankruptcy, you're not a felon, you're not wanted by the FBI, that you don't have any collections or judgments or charge-offs and those things. So as long as you meet those basic necessities, and the better your credit, the better off you'll have in getting pricing on something like this. But that's the whole idea of the DSCR. So the DSCR is, how can I buy multiple properties? And the DSCR is, how can I do that without debt to income? See, in the olden days, you could only buy a few houses. It started off, you could only buy 5, and then you were capped and nobody wanted to do the loans for you. Eventually, you were able to get to 10, and then you'd have your wife do 10, and then you do 10, but then you're capped again. This DSCR allows you to not be capped because they're not looking at debt to income or any of those things. The downside, a lot of upsides to the DSCR. The downside of the DSCR is they want you to put 20% down or have 20% equity. So when it comes to this principle of leverage, the DSCR really isn't helping me on my leverage play. It's helping me on my accumulation. It's helping me get multiple deals without having the debt to income. It's a very valuable tool. But if you just want to buy a property, get a DSCR loan, you're going to be putting 20% down on this. They're going to be using the purchase price as a way to establish the value. There'll still be an appraisal done to make sure that that's in line. It's not a property that's going to need work, because if it needs work, you're not going to be able to get that DSCR loan on it because the property is going to need rehab. So that leads us to the first step before all of this. And the first step is to acquire the property at a discount, get a hard money loan. Okay, I'm going to get a hard money loan. I'm going to fix the property up. I'm going to improve the value of the property. I'm going to rent the property. And then I have to season the property, which is typically 6 months. So I fix up the property. With my lender's approval, I get tenants in the property, and then I let it season. Then what happens is I then go into a DSCR loan. The cool thing about the DSCR loan at this point is, rather than using the purchase price to establish the value, they're going to use an appraisal to establish the value. And as long as I've gotten a good deal, I've improved the value, I should have 20% or more of equity in the property fairly easily, which means when I get this DSCR loan, I wouldn't have to come up with any money because the equity I have in this deal is going to be that 70% or 80% that they may be looking for in something like this, in a DSCR loan. Okay, so if I want to buy properties that are rent ready, that don't need work or anything else like that, I can do that. I'm going to be putting 20% down. I'm going to be paying the closing costs, but they can't need any work done. But that doesn't help me with the leverage portion, which is where I come in with the hard money. And then the hard money turns into this, and I get in with little to no money down. But then we've got to back up. Well, most hard money lenders are going to want 10 to 20% down and want you to make monthly payments and all those different types of things. And that's why we have our up to 100% financing program. The up to 100% financing program is going to allow you to purchase a property as long as the purchase, the rehab, the closing costs, and the payments for the 5-month period are less than 74%. Then all of that can be funded into the loan, so you can literally come in with zero down on that hard money loan. Now, it's hard to find deals like that. I'd say about 20% of the time deals turn out where there's less than a few $1,000s that someone needs to come in with. If you're doing that, you've got to go after off-market properties. You've got to make lots of offers. You've got to work really hard. But let's say that's not the case. Let's say that you only need to come in with maybe $10,000. It's back to that, maybe I have $50,000. How do I spread that out? Instead of doing one deal, let's say this deal was $250,000 and I had to put down 20%, that's $50,000. Oh, wait, there's closing costs and everything else. So actually I'm coming in with about $60,000 of closing costs and everything else. Okay, what if I could put $10,000 or maybe $20,000 into this deal in the front end with a hard money loan? Let's say that the purchase, the rehab, the closing cost comes in and it's $150,000, but I can only get a loan for $140,000. There's a $10,000 difference, okay? That $10,000 difference is something I would invest. So if I have some money, it'll allow me to do some deals that I wouldn't otherwise be able to do because I'd have to go and wait to get those 100% financing deals, and I've got to find an even better deal. So this is kind of the home run versus base hits. But if I have some money, I can go find just an average deal, put a little bit money into that. That money's gonna stay there. I'm not gonna be able to get that money out when I refinance into the DSCR. But what it will allow me to do is buy multiple properties and get the time clicking so we can see property values go up, rents go up, amortization, tenant paying down, and seeing the tax benefits that come along with that. So if you're in a situation where you don't have much money, you're gonna have to really work hard to find properties, which is why we have the tools and resources to find off-market properties, out-of-state owners, all the research that you need to go and find those properties, but you're gonna have to put in a lot more time. If you have some money, you can find more of these base hits. And again, I would be doing these base hits because 20 years from now, you're not gonna really care if you paid $10,000 more for a property than maybe you quote unquote should have. I can give you an example. I bought a house a few years ago for $250,000. I thought that I was way overpaying on this house. And as a matter of fact, I almost didn't buy the property for the $250,000 because I thought I was overpaying for the property, okay? I almost didn't purchase the property. Now, I put about $100,000 into the property, so I was into about $350,000. Well, 10 years later, I sold that house for $1.1 million. $1.1 million off an investment of $350,000, which, by the way, I thought I was overpaying for. So if I'm overpaying on this, in my mind, guess what? The hard money lender is not going to want to have me overpay, but maybe I got to come up with $10,000 or $20,000 that I was hoping I wouldn't have to. Well, guess what? 10 years from now, you're not going to care because the property values historically could have doubled by then. And you're saying that extra $10,000 wasn't worth it. For me to have that much gains in a short period of time, was that overpayment of $10,000 really a bad idea? No. In the long run, it's worth every penny of that, okay? So if you don't have money, you've got to hold out, you've got to find those 100% financing deals. If you do have some money, you can do more of those base hit deals. Now, what happens is you're going to buy that property, you're going to fix that property up with the lender's approval. You're going to put tenants in there. You're going to get approved for the DSCR. Once the seasoning time has passed, you'll be able to get that appraisal and refinance into the DSCR loan. However, the money that you had to put into this hard money loan to begin with, you're not going to be able to get that out. It's not like you can get a cash out refinance in this. In some cases, there's a cash out refinance, but it's a much more difficult. Don't plan on that. Plan on just leaving that money in. But that gave me the ability to do a deal that I wouldn't otherwise be able to do. Again, we're back to leverage. It is going to be more expensive to get a hard money loan and move into a DSCR loan than go right into a DSCR loan in costs, but it's going to be a lot less capital that you have to come up with that enables you to do the deal. So does it really matter if I'm paying $5,000 or $10,000 more to make a transaction like this happen? No, because 10 years from now, that property value is probably more than doubled. And I've got the tax write-offs and I've got the rent increases and everything else that comes along with this, including the tenant paying off my mortgage. All of that happens. And I was able to do a deal when I wouldn't otherwise have been able to because I only had $10,000 or $20,000 and I would have needed $60,000 to start with the DSCR. This is all about leverage. The question you should be asking yourself is, how can I get into a deal with as little money as possible? That's the question you should be asking, not how much does it cost or what are the points or what are the origination. Do those things matter? Relatively, but are they the most important thing? Absolutely not. As long as I can make money on the deal, and I know there's money to be made on this deal, I'm less concerned about what I pay and a whole lot more concerned about what I'm going to make. But more than both of those combined is how can I leverage in order for me to let the appreciation happen, in order for me to see the rent raise over time happen, in order for me to see the property value increase happen, in order for me to see the tenant paying down my value, paying down my loan balance on this property that matters. More important, and seeing all of the tax benefits I'm going to get from this investment. The reality is, if you play your cards right, you probably should get a tax savings pretty equal to any additional costs you'd have with this anyway. So you're probably the same or better off in doing a strategy like this than you are going straight to that DSCR loan. All right, so let's walk through some of the steps to make this happen or make this a reality. Step one is you close on your loan. You close on your hard money loan with Investor's Edge. We wire the money to the title company or closing attorney. Step number two is you do the rehab to that property to value add to improve the value of the property. The next thing you're going to do is get pre-approved for that DSCR loan and wait that 6-month seasoning period, okay? Then we're going to get into this finding and vetting a tenant, which, by the way, you can find and vet a tenant. You don't have to wait 6 months to do that. As soon as the rehab's done, the property's in good condition, you'll find and vet the tenant. Now, I will tell you, we're going to have to approve that tenant. We're going to want to make sure they're a great tenant and they haven't been evicted and they're not going to trash the property or do damage or any of those types of things, which is in your best interest anyway. So we're going to do that. Those payments are going to have to be made to the Investor's Edge, which will be credited to your hard money loan. Okay, so you'll get credit for that. Awesome. Now, then we approve the tenant, the payments come to that and go there or go into your reserve account. Then next step then is you refinance into the DSCR. This is after that 6-month waiting period in most cases. And then you're able to be into that much lower rate. Now, keep in mind the DSCR loans are typically 30-year loans. They're going to be at a fixed interest rate and they're going to be at a much lower rate than a hard money loan. A hard money loan is short term and a lot higher interest rate, where a DSCR is going to be a lower interest rate. It's not going to be as low as going to Wells Fargo to buy a house for you to live in, because going to Wells Fargo for a house you live in is going to be a lot less risk for a bank, where this takes on more risk, but it's not going to be significantly higher like you would with a hard money loan that's a short-term loan. So these are the steps in making this happen, to utilize leverage to get into the game of cash flow. Now, one of the things I like to tell people is my definition of financial freedom is how many months you can go without having to work. Now, you may want to work, you may choose to work, but how many months can you go without having to work? Now, that brings two things into the equation. It brings in how much are you spending, because the bigger your lifestyle is, the more cash flow you're going to have. And then it has passive income, or cash flow, is the second part of that, right? So the passive income or cash flow, how much you're getting from that and how much you're spending and how many months can you go. And the real thing you want to see here is indefinitely. Now, the only way that you can do that is if you start investing in properties, holding those properties, letting that time go and seeing the appreciation and seeing the rent increase over time. So I hope this has been really helpful for you. If you are interested to see if you could qualify for the program like this, from the hard money to the DSCR, I would love for you to schedule a free consultation with one of our investment associates. They'll ask you some questions, nothing personal, get to know you and figure out if this is something that would work for you. So please schedule a time with one of our investment associates and they will walk through you if this is something that you could qualify for.